Hi everyone, welcome back to my channel. So today's video is going to provide the top 10 strategies and tips along with investing recommendations of 2025 in reference to the most asked questions that I've had. So it's basically just a recap of some of the most important things that I've covered. And this is just based upon the topics that come up most often when I'm mentoring new traders and the trends that I see commonality in. So I'll go ahead and replay those topics. That way, as we enter into 2026, if you are a new investor, you'll at least have a reference point on some of the most important things to know. Okay, so jumping straight into it, coming in at number 10, if your potential losses are equal to or greater than your potential gains, it becomes difficult to grow consistently. A strong risk to reward ratio ensures that even if some trades don't work out, the winning trades will more than make up for it. As a new trader, you want to target a reward that's at least 1.5 to 2 times your risks. So if you risk $50, aim to make $100 plus on a trade. This way, even if you only win half of your trades, you're still net profitable. And this also helps to avoid trades with low upside and high downside. And what this means is that just because a trade feels safe, it doesn't mean that it always is. As mentioned, if the potential loss is equal to or greater than your potential gain, you're setting yourself up for slow or no progress at all. So you want to avoid that completely. All right, and now for number 9. So the first thing you'll see here is under spot. It shows the exposure, and of course we're looking at the gamma. Then of course it shows us here a good breakdown as far as like a bar chart, and we can see the open interest here in purple, and then of course the volume is here in yellow. Now one of the things to keep in mind is, again, you want to pay attention to the at the money strike price because they have it leveled here in the middle. It's super important to make sure that you're keeping track of this and understanding how this is going to function. Now underneath that, you're going to see where it says gamma exposure by strike. And of course, this is given a similar information as well. We see the put gamma in purple. We see the call gamma here in yellow. And then this fuchsia color here is showing us the net gamma. So scrolling down just a little bit, you'll see here, again, these are all going to be the strike prices here. And then at the bottom, you're going to see the gamma. Now, so lastly, you'll see underneath that, it's going to show you the largest GEC by strike and expiry. So if we take a look here, you'll see that they have the same information, but you're able to click on this drop down here and look at the expiration dates. So let's say, for example, you wanted to look at, let's say, April 3rd. Click on that. It'll pop that up. If you wanted to look on any date you see here, go ahead and click on it, gather that information, and again, use it for your evaluation. That way you can just improve your trading, because the main thing to get out of this is just understanding how price action works, but more importantly, what is dictating price action. And the gamma exposure is one of the main things to do so, as mentioned. Okay, so going right into number 8. So one ideal strategy that you could utilize is directional debit spreads or bullish butterflies when playing post-pullback reversals off the 200 EMA support. And the reason I think that's super important is at the correlation range. Now with Amex, there is a higher correlation with JP Morgan and GS during economic inflection points, but diverges during inflation prints due to consumer exposure. So think of it like this. Amex tends to move in sync with JP Morgan and Goldman Sachs when the economy shifts direction, like entering a recession or recovery, because all three react to broad financial trends. However, during key inflation updates, Amex often trades differently since its revenue is more directly tied to consumer spending, which reacts faster to rising prices than institutional banking does. So I hope that makes sense. Okay, so now we'll go ahead and jump into number 7. Now, when we look at this second trade here, again, you can see the timestamp. You can also see the days to expiration. So it's set for June 20th. It's at a 190 strike. And then we also see that this is a play for puts. Now, with the quantity of contracts, there were 1,000. We can see the price is at 37.45. And we can see that the exchange is at PHLX, which is essentially the NASDAQ. So just look at it like that. We can see the market. We also see the delta is at a -1 and it's even. And we can see the implied volatility is not listed. And then we also see the underlying stock price was at $152.53 at the time of placing the trade. We also don't see anything listed under condition. So now what this tells us is that this is a deep in the money put simply because it's placed at this 190 strike here versus the actual share price was at $152. Now the delta being at a -1, this means that there's a 1-to-1 price movement with the stock, essentially functioning like a short position. Now this is a very high premium. Roughly over 3.7 million in premium was exchanged on this one trade. Now with no implied volatility and no condition tags, this suggests a straight directional trade. Now institutions love this setup because it allows them to shift exposure without making too much noise, because there's nothing at all that's coincidental about this. And it could be maybe like offsetting risk in a different ticker or even banking on sector rotation. Either way, it's a signal. It's not just a trade, y'all. All right, coming in at number 6. Now, unlike trend lines or indicators that lag, the RBR highlights heightened activity, specifically areas of demand, where price pauses before continuing upward. Now, this is where buyers re-up their positions or settled enough sell-side pressure to push higher. So let me go ahead and break it down from top to bottom so you can spot it, trade it, and use it to your advantage. Now, I am on the 15-minute time frame here, just to provide a little bit of a larger scope on this specific breakdown. So a rally-based rally for the most part, again, is going to be a 3-price structure. Of course, you have the rally. This is going to usually be aggressive as far as the move upward with large bullish candles, and you can see that here. There's then the base that is created, which is basically like a pause or tight consolidation. And this is generally going to be small candles with little volatility and very controlled. You'll see a couple of them that have larger bodies, but for the most part, if we were on like a 2-minute and I was looking at this on a smaller time frame, you would see that conviction in the body of the candle shorter. Now with this pattern, this signals that buyers were in control. They took a breather to fill more orders and then push higher to gain control once again. So the structural breakdown is of course going to be the first impulse, which is the set of candles here. They're strong and bullish as far as the momentum. So of course they're big body green candles. And you'll also notice that they have very little to no wicks at the bottom, which shows high buying interest, possibly from larger institutions or funds. So institutions buy from late sellers thinking the move is over. However, that second impulse, which is that second rally to the top, this is another surge upward, usually faster and stronger than before. Now this confirms that buyers have overwhelmed sellers in the base zone. So it's good to keep in mind that the base in an RBR is where the market makers, institutions, or even like algorithmic buyers, where they accumulated the positions. So when price returns to this area, there's a high probability that unfulfilled buy orders are still sitting there, making it a premium entry zone for a long position. Okay, y'all, so we're about halfway there. Now we're going to go ahead and take a look at number 5. Now we can clearly see that there is a strong correlation between these two as far as performance is concerned. And the reason being is because about half of QQQ's holdings also appear in SPY, which is why they move nearly in sync with each other. So let me go ahead and show y'all another example with NVIDIA and Tesla. I'll go ahead and zoom in here so y'all can see a quick comparison. Now, of course, it won't always be the exact alignment, but again, there's still a correlation. And then the last example I want to show on this real quick is going to be AMD. I'll pull that up against AVGO. We're going to pull up Broadcom. So I'll go ahead and zoom in here, and let me go ahead and zoom in on AVGO as well. So at this point, I think y'all pretty much catch the gist in what I'm saying. Essentially, I'm just showing y'all examples on how certain stocks and ETFs synchronously come together to have alignment. Okay, so now number 4 on the list. So to elaborate on this a little more, I'm going to go ahead and zoom in here, and I want to go ahead and briefly discuss mistimed entries. Many traders may see the right move forming, but they enter before confirmation. And in some cases, price is still retesting, liquidity hasn't fully shifted, or volume just hasn't validated the move all the way. And that's where problems may arise. An otherwise easy trade can quickly become a regret just off those 3 components alone. So price, liquidity, and volume play a major role in how a trade fares in your favor or against you. So let me point out a prime example. This candle here at 9:16 a.m. today. Obviously, this is a bullish candle with a strong body. And then the next candle immediately thereafter at 9:18 a.m. was also a long bullish candle as well. Now we can see here that this candle's open was pretty much at the close of the candle that preceded it, hence confirming and showing strong momentum to the upside. Now volume also backed these 2 candles as well, because we can see a high level of participation in the market at this time. Now some new traders may mistakenly think that this is a perfect time to enter. 1, because volume is backing it, and 2, because we see 2 aggressive bullish candles to the upside. And because there's so much buying pressure within these 2 candles, that would serve as also further confirmation that this may be a valid trade. However, experienced traders will look at this and understand exactly what needs to take place in order to make sure you are fully confirming this trade. So the very next candle here at 9:20 a.m. is a candle full of indecision. So let me zoom it in a little bit more so y'all can see exactly what I'm talking about. So if we were to go here and take a look at 9:20 a.m. as mentioned, this specific candle has a decent sized upper wick and a longer bottom wick. Now the body of this candle is fairly short in comparison to the candles from the previous 4 minutes. Now what this would immediately alert to experienced traders is that there's a level of indifference in the market. And one is simply just based on the wicks alone, and then also combining that with the short body of the candle, and then also with the slight drop off of volume. But it doesn't stop there. If you were to take a look at the body of this candle, you'll notice that it's actually inside the top wick of the candle that preceded it. So if you're brand new to trading, you may be questioning, okay, well, what does that mean? What does that have to do with anything? And the most simplistic way to break this down is think about it like this. The upper wick is showing you that this is the highest that the price was for this specific 2 minutes, because I am on the 2-minute time frame. And with the stock being pushed to the highest of those 2 minutes, we can see that there was not a ton of selling pressure because the upper wick is not that large, hence showing that at this time buyers were in full control for the most part. Now, how this contrasts with the candle that follows here at 9:20 a.m., with the body of this candle being in the same range of the upper wick of this candle, this clearly displayed that there was no more room for any more buying pressure because the body of the candle did not exceed above that upper wick. And because it didn't exceed above the upper wick, it shows that there's a slowdown, there's lacking intensity in the buying interest. So I hope that makes sense. All right, y'all, so we're coming down to the wire. Now let's take a look at number 3. Now, in this middle section here, this is where you're actually going to set the conditions to your order. And to do that, all you simply have to do is click underneath symbol. You're going to go ahead and click on the box, and you'll see that the ticker symbol that you selected will pop up automatically. From there, you're going to go ahead and click on method, and you can choose to have the bid, the ask, the mark, or any other option you would want. You can even click on study, and you can have this set for any type of technical indicator of your choosing. You would just simply click on edit. But we won't go over that right now. I'll leave a link for that video down below where I discuss that. So I'm going to hit cancel on that. Now, the main thing to consider when you're setting these conditional orders is the trigger. So if you hit this drop down right here, you'll see it shows you that it can be less than or equal to, greater than or equal to, trail stop, less than or greater than. So it's completely your choice on what you select. For example purposes, we're going to go ahead and leave it at less than. Now, the next thing to consider is the threshold. This is where you can click the plus or minus button here or type in the specific number that you would want. It could be anything that you choose that would make sense for the trade that you're trying to place. Now, this is one of the main things to pay attention to because whatever number you set is going to make or break the order in its entirety. Okay, y'all, so we're winding down the list. Now let's go ahead and take a look at number 2. So we can see here at the start of the market, the price ran up aggressively in the morning session and peaked at $176.77. Now, this rally was pretty quick and steadfast to the upside, and we can see that this occurred above this VWAP line here, showing strong bullish momentum early on. However, that strength was short-lived. Once price dipped back below VWAP, it failed to reclaim it for the rest of the session. So from this point here at about 9:42, 9:44, and 9:46, we saw that the candles wicked above the VWAP line. However, they did not actually close above VWAP. Hence why there was not enough buying pressure to push through this level. So after the initial high, the price pulls back through the VWAP and attempts to retest it in this zone right here. But notice that these multiple attempts to reclaim the VWAP at this 174 level failed every single time. So every single approach here got rejected. Now this is a key sign that sentiment shifted to bearish intraday moves. The volume weighted average price is now a ceiling at this point. Now, there is a ton of sustained rejection within this because we can see that once it leveled under VWAP, the price entered a prolonged downtrend. Now, what makes this chart stand out is that VWAP acted as dynamic resistance throughout the entire rest of the session. And we can clearly see here that each bounce attempt failed. So here at about 10:20, we can see it kind of got close to touching the line. We can see here at about 10:44, we see it wicked above it, but again, it was still rejected from the line. So this is indicative of distribution, not weak decisions of selling. Okay, so now we're going to go ahead and take a look at what's number 1 on this list. And again, this is not something that I specifically chose. It's just the commonality that I've found in most questions, what's been most talked about, and what's been most frequently discussed as far as strategy. So at the top spot for 2025, let's get into it. In the money options have a strike price that is below for calls and of course above for puts. Now these options have intrinsic value, and the difference is between the strike price and the current stock price as explained. But within the money options, they have more value than at the money or out the money, making them more expensive. So if you were to select a call option at this 138 strike, this would be out the money. And the same would also be true for puts. If you were to select the 136, this would also be out the money for puts. Now these classifications help traders understand the current value of an option, its potential profit, and how often it can differentiate certain strategies. Now, does this mean every single time you have to trade in the money? No. If you have a specific strategy that allows you to trade at the money or out the money and it works for you, then of course that's completely fine. But I will say 9 times out of 10, in the money contracts are going to be your best friend. But it's one thing to take my word for it, so I want to go ahead and show y'all a back test so y'all can see how this would play out in real time. In order to start backtesting within Thinkorswim, all you simply have to do is click on this On Demand button here at the top right. And from here, you'll see the Think On Demand confirmation pop up. Just simply click on OK. And now I'm going to go ahead and select this particular drop down for the calendar. You guys can see it set here for January 15th. I'm going to leave it at that time as far as the date, but I'm going to go ahead and select it to be at, let's say, 8:35 for right now. We'll go ahead and select Go. We wait a second for it to pop up, and there we go. Now we can currently see that NVIDIA was trading for 132 on this particular day. So I'm going to go ahead and quickly place a few trades so y'all can see how this plays out. So again, 132 is going to be the actual share price. We're going to go ahead and look at calls just for this example. I'm going to go ahead and click on Ask. We're going to go ahead and put this at a market order. I'm going to go ahead and buy, let's say, 10 contracts just for example purposes. I'm going to click on Confirm and Send. We will send it off, and that's going to be the 132 strike. Again, that's at the money because it's actually at 132. Now I'm also going to do an in the money. So in this case, it would have to be what? Again, below for it to be a call. You have to select the number below. So below 132 is going to be 131. I'm going to go ahead and click on the ask price here. Set this to be a market order again. We'll also do 10 contracts. I'm going to go ahead and confirm and send it off. And last but not least, we'll also go ahead and do an out the money. And again, 132 is the current share price, so we need to go above for it to be out the money. I'm going to go ahead and click on this 133 strike price. You're going to see it's set for 10 again for the number of contracts. Go ahead and fulfill it at a market order, confirm and send, and send. Okay, so now we can see how this is playing out here at the bottom, but I'm actually going to go ahead and click on this monitor tab here at the top left, and we're going to go ahead and look at the positions we have. So I'm going to look at the 3 fulfilled. We'll see it here. You can also click this drop down under instrument and it'll show you exactly what you have selected. Now in this case, we can see the numbers moving. So again, the 131 is going to be the in the money. We see the 132 is at the money. The 133 is going to be out the money. So let's look and see how this P&L is going to perform based upon the numbers we see here. So we see it's pretty split even at the time, but as it continues to progress within the trading day, obviously this is a back test, so I know how it's going to play out. But you'll see progressively what the numbers do. And this top number here, this 131 call, is going to generally be the highest number as far as profitability. But I'm going to let y'all see how this plays out as we continue throughout the video. Okay, so perfect. So you can see here, again, we fast forwarded to January 17th around the same time. Let's look at the profitability. So the in the money is going to be at $1,820. Well, it's going to continue to jump. The at the money is going to be the 132 call at $1,645. And then the out the money contract is the 1,495. So clearly the winner here is going to be the in the money contract. And I can tell y'all just based on experience that this is often the case. You will see in the money contracts give you the most profitability. So y'all can see the numbers for yourself. So it's not like you have to listen to my word. I do recommend conducting a few of your own back tests so you can see how these numbers play out with your own trading strategy. But again, don't take my word for it. Test it out for yourself to kind of see if it fits and it makes sense. But I can assure you 9 times out of 10, the in the money contracts are going to be way better as far as being beneficial to your P&L. Okay, y'all, so there it is. That's the top 10 for 2025. As far as content that I've covered, y'all feel free to let me know what y'all want to see for 2026. Obviously, there's plenty more to discuss, but with that, that'll pretty much do it for this video. So if any of this information was helpful, feel free to leave me a comment down below. As always, I thank y'all so much for watching, and of course, I'll see y'all in my next one.